Hi, my name is Carl Michael Seiding. I'm a Swedish investor, a former hedge fund manager. I'm also a fintech entrepreneur and a technology angel. In the investing course, I teach a simple and robust method of value investing. I literally started from nothing and still became the European hedge fund manager of the decade, as you can see here. This is another prize for one super year we had in 2008. And this is me back in 1994 when I started out as an analyst. I think it's time you unlocked the potential of value investing for yourself. Value investing is the practice of buying companies for less than they are actually worth, with a sizable margin of safety. That sounds like magic, right? Well, it isn't. It's definitely not too good to be true. The reason it can be done is straightforward. Stock prices move much more than underlying earnings, and underlying earnings move way more than the underlying economy. I can show you how to use those swings reliably to your advantage. The excess stock market volatility is a source of profits, not ulcers. Keep listening if you want to learn more about the hands down best value for money online investing course there is. I have more than 30 years of experience as a finance professional, as an analyst and a hedge fund manager, not to mention private equity investor, with not one or two, but actually several hundred baggers under my belt. Does that sound interesting? Well, stick around. Invest just a few more minutes into your future. Social media can wait. My 6-week online course will take anybody from beginner or intermediate to the level of many experienced investors. It's the method and process that I use myself and I have perfected during over 30 years as a professional investor since I started working as a sell side IT analyst back in 1994, right before the IT boom took off. The sooner you learn how to make your capital multiply while avoiding the big losers, the faster you will reach your goal of financial freedom. You just need the right investment skills that I can teach you. That says my career. I quit as a sell side analyst at the peak of the IT boom in 2000 and joined a hedge fund where I could short hyped up IT stocks, that is, making money from share price falls. We had a great run owing to our fundamental value based research and investment process. We actually gained 600% over about 10 years, while the stock market returned just about nothing. We went on to win several hedge fund awards, of which I keep a few here with me. One of these is actually for the European Hedge Fund of the Decade between 2000 and 2009. We beat thousands of our European peers in terms of risk adjusted performance. And we had zero down years, no losing years whatsoever, and several stellar years for which we got some of these other single year awards as Best Equity Hedge Fund. Okay, that was us. But what are your goals? Do you want to escape the daily grind? Are you longing for retirement? Well, already? Or just the freedom of traveling or eating whatever and wherever you like? I can understand that. Have you dabbled a bit in investing but never really produced sustainable gains? I feel you. Are you worrying about the future for you, your own, or your family? Not feeling that you are enough? Do you want more? Do you want more meaning, more downtime, more freedom to choose? More money can't do everything, but it sure helps with the daily grind. I can tell you that. The investing course, it is for you. And you actually don't need any financial experience, education, or degree to grasp my material. It really is that easy and straightforward. If you can count and read, you can find great companies and know when their stocks are selling at bargain prices. This is what the investing course is all about. So this is how I will make a great investor of you. And I will now go through week 1 through week 6 of my program, the Investing course. You will learn skills, methods, tools. You will walk through step-by-step real-life investments to hone a reliable investment process that will last a lifetime. And you'll get to know like-minded, ambitious, and smart investors. We are getting rave reviews from our participants from the 9 Swedish cohorts, as well as the first and second cohorts of the Investing course. So, escape, stop grinding, reach high living, stop worrying, get real results fast. And it is that easy. From beginner to intermediate or even to professional level, given enough time and effort. So, the most important thing in exceptional results is doing what others aren't. Buy at the cheap when misunderstood, when nobody is around, and sell when inflated due to excess optimism, when everyone is crowding in on the same trade. And I can teach you how to do this in 6 weeks. So, during week 1, we will focus on the concept of cheapness. We'll also go through value and valuation methods. My main focus will be on the equals F times V method. The price of a share can be broken down into its fundamental component and a valuation of that fundamental component. So the easiest way to go about this is to first measure the company's earnings. So its profits, that's how much money it makes. It sells something, it has costs to sell those things, and then they earn a profit. So how many times that annual profit is the company worth? That is what the P equals F times V method is all about. You can think about it like this. If somebody promises you to get $10 every year for the coming 10 years, you will get a total of $100. How much is that actual worth? So if you don't care at all about the time that it takes 10 years, or the risk that the person promising you this money that they fail to deliver on their promise, then the total value is the sum of this stream of cash flows. So it's 10 times 10. So the annual, let's call it profit, or the annual cash flow, the annual promissory note here is 10. And you value it 10 times because it will occur for 10 years. But what about if it's for 20 years or if it's for eternity? Here is a different way to think about it. If you pay 100 for an eternal stream of tens, you get 10 every year for that 100 that you paid for this stream. That means you gave away 100, but you'll get a 10% return every year on that investment. That sounds like a pretty good deal. Like if you go to the bank, you'll get about 5% every year. You give them 100, they give you 5 every year for eternity, or as long as you want this process to go on. And then once you're done with each other, you get the full 100 back. But if you get the 100 back an eternity from now, then it's actually worth nothing to you. So at the limit case, what this is worth to you is the annual return. And if you are happy with 5% or 10%, then that's how much money you can accept for that 100 every year. So if you accept a 10% annual return, which I think it's pretty reasonable often for stocks and for investments, then that means that you value an annual stream at 10 times. You can do this for bonds, you can do this for stocks, you can do this for any type of investment, including a bank account, apparently. So P equals F times V. That's the concept that we go through in week 1. In a way, you can say that this is the quantitative method of valuing anything, a company, a project, a security, whatever you like. And it's built on the assumption that you already have all the relevant facts. Like, for example, how much will you actually get every year? And what is the price of this thing that you pay for that promises these annual returns? So, given that you have all the relevant information, you can use the quantitative method of P equals F times V to value the project, the company, the stock. In week 2 of the investing course, I will go through how to find new potential good stocks to research further. I have to stress research further because this screening process, using a combination of fundamental and technical filters to find new stocks that appear cheap or in a positive trend, that is only the beginning. You will have to actually research those companies further afterward. But this is a very good starting point. So, in week 2, I will show how to find new interesting stocks. One of the most important tools to do that is using an online resource, a stock screening tool. You can find these everywhere at Coifin, Investing, well, you name it, Bloomberg, Yahoo, there are stock screeners everywhere. The magic in the stock screener, the value of a stock screener, is how you combine a number of filters into a smart search method. So, for example, many beginners, they start by looking for companies that grow their earnings quickly and are valued cheap on these earnings. That is typically, unfortunately, the recipe of finding a value trap, because for some reason they are cheap. There is often a very good reason for a company that has grown quickly and has a superficially low price earnings ratio, that they find themselves in this situation, and it's because something has changed. An equally superficial and not that productive method is to just simply go for the highest growth company you can find and just disregard their valuation metrics. That is typically also not a good way to find an under-researched stocks, an unloved stock, a cheap stock. No, the typically best way of finding a cheap stock is looking somewhere in the middle and applying a little bit more intelligence to your search process, and not least the subsequent real research process, and the understanding what the company actually is all about and how it's actually producing value. So that's week 2, screening and filtering, finding new potential investments. Week 3 is all about making more reliable forecasts and valuations. So, during the first 2 weeks in the course, I talk about how to discover new stocks to invest in and how to assess their value based on given so called consensus information about current and future prices and profits. I call this: is it cheap? Is it cheap enough? How cheap is it? How cheap is it compared to what? What does cheap actually mean? And what returns can I expect? In week 3, the objective is to improve the forecast quality by modeling future earnings ourselves based on our understanding of the company's business model and industry characteristics. Okay, so that's a mouthful. In any case, you can see this as the qualitative side of investing and valuation. So in week 1, I showed the quantitative method, just applying valuation multiples on a given set of forecasts for earnings, sales, equities, number of employees, whatever fundamental you can find. In week 2, I showed how to find new stocks to value and invest in. And in week 3, we go through these methods of how to understand a company's business, how to put the company, how to assess the company's position relative to clients, to competitors, to sub-suppliers, and so on, to the law, to authorities, and so on and so on. What we're really trying to assess, it is: how certain can we be that the company keeps producing growth, margins, and earnings as good or even better than they have up till this point. So we will look at their history. We'll try to understand why they produced those historical numbers and if they can keep doing it. And one of the concepts here is, of course, the infamous moat that Buffett and Munger always talks about. Them. So what we're talking about when we're talking about a moat is something that is protecting the company's profits from other intruders. And what we're really trying to assess is, even if the company has grown by 15% per annum the last 10 or 15 years, how certain can we be that they can keep growing faster than the general economy and being perhaps more profitable than the general economy? That is the durability and reliability components of stock investing and valuation. And that is week 3, durability and reliability. So now we're at week 4 of the investing course, timing. We all want better timing in life and not least in investing. So this is the concept of timing in investing. Once you actually have a watch list of attractively valued long-term investments based on quality forecasts made with a thorough understanding of the business model and competitive environment, and you are ready to invest in one of them, you should consider whether it's a better than average time to invest, or if you should wait for a better opportunity with lower price or less uncertainty. So, in week 4, I teach how to use the following tools to better time your investments. 1, technical analysis. 2, macroeconomics. 3, long-term trends and narratives. 4, making a timeline. And 5, using a checklist. So, technical analysis tools, they aim to measure the current eagerness of buyers and sellers. The 200-day moving average and Bollinger Bands, they are commonly used indicators. They are the simplest and most intuitive TA tools, and the ones that I recommend. They should, however, still only be used as marginal inputs for better investment timing and not as decisive investment factors. Macro. Usually, one can and most often should safely ignore macroeconomic data. Sometimes, however, factors such as the overall market valuation, interest rate trends, or PMI data might matter enough to take into consideration if they are really, really extreme relative to their normal ranges. Hedgeye's 4 quads, Hussman's valuation charts, and Howard Marks's cycle assessments, they are effective shortcuts to outlining the state of the macro instead of doing all the tedious work oneself based on Fred data. So that's TA and macro. And then we have long-term trends and narratives, making a timeline. Making a timeline is about taking a calendar and pinpointing things that you know will occur in the future and things that might occur in the future. Anything that you can more or less reliably predict will occur, such as earnings reports, political decisions or elections, capital markets days for the company, and so on and so on. Maybe product launches or product launch events, things like that. So you use this timeline to not get nasty surprises or be blindsided by new events that you, if you had just thought a little bit more, you knew that they would likely happen on that date. So that's using a timeline. And finally, a checklist for better timing. That's simply, a way of making sure you don't do any stupid and easy mistakes. So we're almost done here. We're at week 5, portfolio management. Week 5 out of 6 in the investing course. Portfolio management is about creating, managing, and optimizing a collection of stocks, so more than one. So I have four basic rules. One, don't try to hit home runs. One, don't try to hit home runs in hype and hope stocks. So focus more on avoiding losers than finding 10 baggers for your investment portfolio. The upside, it takes care of itself through economic growth and value creation, as long as you avoid common, simple, stupid mistakes. Two, keep some dry powder ready for buying good stocks on sudden price falls. There are times to go zero cash or even use leverage. There are such times, but most of the time, you should keep cash at hand to be able to participate in sudden, extraordinary opportunities. We'll talk more about that in the actual course. Three, rebalance your portfolio regularly, albeit not too often, of course. So avoid day trading your value based investments, but at least you should rebalance annually. And four, try to come up with a workable stop loss strategy or stop profit. This is much harder than it might seem at the get go. That's why I'm emphasizing try to come up with a workable stop loss strategy. But we'll talk about that. So, portfolio management, designing, maintaining, and optimizing a portfolio. Designing a portfolio entails ranking one's best investment alternatives and buying most of the stocks with the best risk adjusted potential. Then maintain your portfolio by researching and comparing new potential holdings and updating your list of potential new investments. Add the highest ranking one and eventually sell the lowest ranking one on a good day. Finally, optimize by trading unwarrantedly outperforming stocks for more of your hopefully temporarily underperforming assets. So you actually sell the winners and buy the losers. But it's not that easy. Anyway, this dynamic, whether based on performance or regular time intervals, leads to the accumulation of additional units, number of shares, of each asset in the portfolio over time. So it's called a volatility dividend, since the price swings are utilized to garner a higher total return over time. And that's it for week 5, portfolio management, maintaining, designing, and optimizing your collection of several stocks. So, finally, week 6, case studies, tying it all together. In the final week of the investing course, I show how to apply the TIC tools and methods in practice, from idea generation to pitching and post trade analysis. So, by now, after week 1 through 5, you should know in theory how to find interesting investment prospects, how to compare and rank their absolute and relative attractiveness, how to make forecasts for fundamentals and valuation levels, and time your investment based on TA and macro considerations. You also already know the importance of keeping an investment diary and using it for refining your investment strategy, as well as your very note taking skills themselves. In practice, however, it's a little harder to remember all the necessary steps. So, to make the lessons stick and cement your new skills, in week 6, I go through several investment cases from start to finish. The main case that I base week 6 on is Tesla, and it's actually a short case. The case has been valid for several years. It's at least as valid now as it was 2 or 3 years ago. In a video from a lecture that I held at the London Business School, and in the supporting documents, I show how I got the idea to short Tesla and how I made my revenue and valuation forecasts and my assessment of the risk entailed in shorting Tesla. As a side note on forecasting, over the last more than 2 years since I initiated the Tesla short case, Tesla has of course enjoyed enormous success with its new car models, the Y, even the Cybertruck, depending on how you will assess that, as well as garnered attention for its Optimus robot. And still, my sales forecast, 130 billion for 2025, it's actually a little more optimistic than the now consensus of 118. I'm recording this in May 2024. So, in practice, nothing has happened in the last 2 or almost 3 years. There has been zero positive surprises in terms of sales outlook. Sure, we'll see about Tesla's final profitability once we get there, but competition in the EV space is definitely heating up, just as one should expect, and it's putting pressure on profit margins, not the other way around. So the funny thing here, and which shows the potential and the power of fundamental valuation, is that all of Tesla's successes over the coming 2 to 3 years since I made the research, they were already knowable and discountable. And although Tesla has enjoyed all this enormous success, it wasn't enough even to reach the forecast that even I, who was pretty pessimistic 3 years ago, forecast. So in week 6, we'll go through Tesla and we'll go through like 5 other companies at least, from start to finish, from finding them all the way through post-investment analysis and strategy refining. So week 6, it's really about tying it all together. And after that, you will be a decent value investor, perhaps not good or great yet, but you will have all the necessary tools and methods and practices and know-how. You will have exactly everything you need to actually become great. But just as a professional golfer doesn't become a professional golfer just by studying theory, you'll have to practice. It will take months and years to actually become a great investor. But using the investing course, you'll shortcut the process and you'll become a good or great investor much, much faster than you otherwise possibly could. Okay, that's a lot to digest in just about half an hour. Luckily, you've actually got 6 weeks. And I promise you that you will find it both easy and fun once you get the basic toolset. Not only that, you will acquire meta values. You will know what others know, which will make you more confident. You will be part of the TIC community. And you will feel confident that you now know how to analyze and invest, and not least how to improve your skills over time. You will feel secure in knowing that you can take control over your future. You will know not only how to analyze an investment and put it in relation to other opportunities, you will also know how to find stocks to research and how to summarize and pitch your ideas, and not least how to evaluate and refine your results in order to become a better and better investor every single year. So, in short, you'll know how to find, analyze, invest, pitch, and evaluate an investment opportunity. After the investing course, you will walk away with at least 12 new skills. Those skills are, in short summary, screening for stocks, forecasting fundamentals, model growth rates, analyze business models, read and understand annual reports, value assets on an absolute basis, rank investment alternatives based on risk and return, time and size your investments based on technical analysis and macro, combine complementary stocks in a portfolio, optimize and maintain your portfolio, track investment rationales and outcomes in a diary for evaluation and strategy updates, and pitching your investment ideas concisely in writing. The investing course gives you the power to be able to analyze anything. You can value any company fast. And you will learn from at least 8 real-life hedge fund investment examples that I lived through. You will learn step-by-step valuation and investing instructions. You will learn how to make robust forecasts, no more guesswork. You will use the P equals F times V framework for predicting the trajectory of any stock you like. And you will also know how to pitch like a pro, how to convince others to invest, and not least summarize your own investment case for yourself, for your future self, in terms of potential, risk, key assumptions, and company characteristics. Here's what some of our members have to say. The investing course at London Business School exceeded my expectations. The content is relevant both for students who want to sharpen their investing skills and those who aspire to work in an equity research role. Michael covered a wide range of materials, such as finding investing ideas, valuation, risk assessment, and portfolio management. In addition to the presentations, the slides and written materials were packed with valuable concepts, says Andrianto Gonturo, Equity Research Associate at AB Bernstein. And then we have Gregory Gettia, the Senior Director at Georgia Capital. I had the opportunity to attend the investing course when I did my master's in finance at LBS, London Business School. The course covers investing in stocks from start to finish. I believe attending the course will be beneficial for people with relatively advanced knowledge of investing, as well as those of you who are just starting your journey as investors. This is a unique opportunity to gain insight into the investment process of a successful hedge fund manager, engage in the discussions with him, and even challenge him. I found Michael's sessions engaging and fun and would highly recommend the course to anyone who has an interest in investing. Very kind words. Thank you. So, about making a horse drink, I think the investing course material is easy. Actually, I know it is easy from all the previous participants, from 9 or 10 actually Swedish cohorts, from 2 previous TIC English cohorts. Actually, a middle schooler can understand the concepts and apply them. So if you are ready to learn, I know I can make you a decent value investor with just a few focused hours a week for 6 weeks. And you will become a decent value investor. However, if you want to become good or even great at investing, you'll of course have to keep practicing after the course is over and you have your diploma. I can only lead the horse to the water. So, who are we? Me, Carl Michael Seiding, and Ludwig. So, my name is Carl Michael Seiding. I'm a 52-year-old retired equity analyst and hedge fund manager with 30 years of professional experience in finance between 1994 and 2023. Before that, I attended business school and took a master in finance between 1990 and 1994 at the Stockholm School of Economics. My hedge fund Futuris won many prestigious awards for its excellent returns and risk management. Today, I advise family offices and foundations on their investments. Plus, I run this online education program, the Investing Course, in value investing, together with Ludwig Sundström. Why should you take the course? Why should you pay for the Investing Course by me, Carl Michael Seiding? Well, I think there is no better way to learn stock investing this fast, with this much confidence, and at this price. You will learn to find, analyze, and invest in stocks to build your portfolio. It's a 6-week only online course. Learn at your own convenience and go over the material again and again if you like. But I also think that 3-4 hours a week for 6 weeks should be enough. There are over 20 hours of video, 50 documents, and 300 tools and resources. It's enough, but it's concise and it's pedagogical. It's simple to learn even if you have no previous experience. I can promise you that. The maths is easy. The concepts are easy. You just have to know them and see them for your own for the first time and guided by an investment professional like me who's done this and thought about this for 30 years. The course has been taught at London Business School, and they have, as you have heard, gotten a lot of value out of it. It's suitable both for beginners and intermediate investors. Actually, it's actually suitable for advanced investors as well. It's actually suitable for me. And I have a proven track record. The instructor, I actually ran Europe's best hedge fund for 10 years during 2000 and 2010. Well, I wasn't alone, of course. We were three senior partners of the main phase of the fund. I was active in the fund between 2000 and 2015. 10 of those years, I was the managing director, apart from being a senior partner and portfolio manager with focus on IT stocks, nonetheless. So, the reason you should take the course is that I actually know what I'm talking about, and I've lived investing and I've lived how to explain investing to others. And I've done this for over 30 years. And now I just want to give back to show how value investing is supposed to be done in a world where there is just a lot of dumb money around chasing momentum. So this is my project. Apply now at theinvestingcourse.com. It's simple, it's intuitive. I promise you, it's pedagogical. You will see real life examples, one after the other, step by step, to really hone your investing skills, to hone the actual practice of finding, analyzing, investing, pitching, and evaluating investment opportunities. You will have an investing skill that lasts a lifetime. Value investing never goes out of style. And you can value any company, any project, public or private. Also, not the least, get your certificate, get your diploma. I know you want to, but I think that you will afterwards also know that you will want the knowledge that is behind the diploma even more. This is the hands down the best value for money investing course that you can find online. There is nothing like it. I know, since I am. This is hands down the best value for money investing course that you can find. I can promise you that. This is hands down the best value for money investing course that you can find. As the actual European hedge fund manager of the decade, I can promise you that. So the next cohort starts very soon. Apply now to be guaranteed a spot when the course launches. It's taught by me, Michael Seiding, and my partner, Ludwig Sundström. You will learn how to find stocks with screening tools. You will learn how to analyze stocks in different industries. You will learn 7 valuation methods to triangulate between. You will learn how to interpret company reports and read annual reports. You will get to build a watch list for monitoring stocks. You will rank your investments by risk and return. And you will get to put together your own stock portfolio. So apply now at theinvestingcourse.com. First, here's a quick introduction to the topic of the investing course. The question here is, should I buy this stock? Should I sell it? Is this stock cheap? Is it attractive? That's exactly the type of questions you'll learn how to answer in the investing course. It's a robust system for forecasting, modeling, valuing, and not least investing in stocks, listed as well as private, public and private. So, TIC, the investing course, it shows how to make better investments on the stock market, what we all want. It shows how to find new stocks, how to evaluate them, rank them, and how to time your investments in stocks and manage a portfolio of stocks optimally. You'll learn how to value stocks and how to use technical analysis and macro analysis to your advantage. If you want to make it really easy, a typical stock is a good buy if it costs less than 15 times its earning per share or 1 times revenues per share. Please note that conditions apply, but on average it really is that easy. But we'll get to the details later. So, a little bit about me. I started with exactly nothing, perhaps not unlike yourself. I was born in Kiruna, of all places, in Jukkasjärvi. Nobody knows anything or anyone from Kiruna. I was born in Jukkasjärvi congregation or Jukkasjärvi parish. It's not even allowed to put into your ESTA application because of the dots over the air. So that's me. No contacts, no contacts. 6 months of night in a row. Vampires abound. So I was born in 1972 in a country sharing a border with Russia. And I became the European hedge fund manager of the decade. Not to brag, but I was not only the portfolio manager, but a senior partner and the managing director for 10 years. So, how did this happen? How was it even possible? When I was 18, I still didn't have a clue about anything, including business or business school. So, but I did apply and I did get into the Stockholm School of Economics, the best business school in Sweden. Actually, the only at least part private higher education in Sweden. And just 6 years later, I was the head of IT research at Sweden's largest bank in 1996, the year the internet took off for real. Yeah, listen to that again. 6 years after graduating from a school I didn't even know existed before, 6 years after that, I was the head of IT research at Sweden's largest bank. And right as the IT boom started booming. So, a little bit of my history. Now, as it is stands now, I've already helped 1,000 people through my valuation classes. I've taught them about the P equals F times V magical ranger formula for robust stock price forecasts and investment prospect rankings. Many of my students have on to become professional stock analysts and portfolio managers. That is if they weren't already and still took my class on their boss's recommendation. That's the level of the investing course we're talking about. And I can teach you to value stocks, public or private. I can teach you to assess or manage risk. I can teach you to control your investments and how to make great investments and buy shares at a discount to their true value. I can show how to get out at the right time after riding the bullet long enough, not before. You'll also learn the interaction between TA and FA, so technical analysis and fundamental analysis, of flows versus stocks, of trends versus valuations, of facts versus fantasy, of fundamentals versus sentiment, and how to balance these aspects for an optimal investment strategy. So, TIC, the investing course, it's 5 weeks, each delving into a specific area of investing. One, two, three, four, five. And then in week 6, it's all tied together with a handful of practical case studies, showing from A to Z how to find, analyze, model, invest, and evaluate an investment on the stock market. Let's have a quick look at Apple as an example. Should you buy Apple? Is the stock cheap enough? Well, we start by looking at the annual earnings per share and the growth rate in earnings per share. In 2023, EPS was $6, but we want to estimate future profits. We want to make forecasts for earnings per share. The value a company creates consists of its profits, and profits is what's left after its revenues, after costs. So, forecasting earnings per share. First, you want to check consensus forecast. So, that's the average forecast from other analysts, and then make your own forecasts. We can see here that between 2024 and 2026, a 7 to 10% earnings per share growth rate is expected, which leads us to 783 earnings per share in dollars per share for 2026. The question is, can we make a better prediction? Rarely, rarely, rarely do we do better than professional analysts, but we can verify. Let's start by looking at sales. I think those are a more robust measure of growth because you can't really expect profit margins to just keep increasing forever. Looking at Apple's history, they have had about a 5 to 10% annual growth rate. And I think that seems plausible also for the forward years. And that's what I have depicted here in the cyan colored line. So at constant profit margins and no growth in numbers of shares, EPS will also grow at the same speed as sales. You can also check graphically if forecast seems to make sense. So here, for example, we can see that the last 3 years, EPS has been about $6 per share, but growing a little bit. And it seems as if earnings per shares plateau and then accelerate when Apple launches new products. So reaching about $8 per share, as was the consensus forecast around 2026 or 2027, that actually looks reasonable in a chart, but it's hardly a given outcome. What we do have, we have facts, that is fundamentals, the fundamental facts about a company. It's not really a fact yet, but in the future, there will be a certain earnings per share, which will be the fact. The question is, how much fantasy will the market have about that fact? And the valuation, the faith in the future, that is, or the faith in the forecasts, that valuation multiple of earnings per share is what, together with the fundamental, creates the total share price. The investing course method and model can be summarized as fundamental times valuation equals the stock price. So the price of any stock can be broken down into its earnings per share and its PE multiple. And that goes for now as well as for later. At any point in time, any stock can be broken down into these two components and analyzed one variable at a time. More generally, the stock price at any time can be broken down to a fundamental fact and to a fictional multiple, a number of times, that is, number of years or valuation multiple of the chosen fact basis. For Apple, the equation currently is the stock price is $165 and the earnings per share is $6.13. And the earnings multiple is 27. This is calculated on actual reported 2023 earnings per share. Apple at 165, the fact is 6.13, and the valuation faith is 27 times those earnings. The valuation multiple expresses the market's faith in Apple's capacity to keep producing annual profits or a certain profit growth at high enough levels to eventually pay the investment back and more. With just constant EPS, that would take 27 years before you get your money back from Apple. And just imagine all the interest and the alternative investments that you lose in the meantime. Trying to estimate Apple's future valuation multiple, looking at Apple's own history, it has shown a wide range between 9 and 45 times earnings. But the trend and current kind of floor base for the valuation multiple seems to be about 20 times earnings. A note here is that S&P's average valuation multiple in terms of earnings per share over time, over long periods of time. Right now, the S&P is quite a bit more expensive than that, but over time, the average multiple for S&P is 16 times, and Apple's average is about 20 times. That seems about right for a little bit better company than the average S&P component. And I'll think Apple deserves better than average. So 20 times is kind of okay, but you should be prepared that Apple's PE multiple could fall back to 13 to 15 again sometime. And it has in the worst years, like 2013 and 2016, it's been down to around 10 times earnings. So when the market loses its faith, it kind of loses it completely. What will the market in Apple look like 3 years from now? Well, it's hard to guess other than average without deeper knowledge. So let's say it comes to a market multiple of 16 times. So that's the time-tested wisdom of the markets. That typically results in a 10% total return if you invest in the index. Apple, it should still have better growth rate and risk than average once we get there. So I think a 20 times warranted PE is quite a good guess. And that will be based on the at the time last 12 months EPS. So last 12 months once we get there to 2027 or 2028. Also, something to consider is that in a recession, both the earnings per share and its valuation multiple could be below trend, possibly permanently. And that's part of the investment's risk. Is Apple a good investment? Well, we wanted to estimate a likely future valuation multiple to go with our forecast EPS level. So assume now that it's summer 2027, and we know that the 2026 calendar year EPS was $8. If we already have estimated that the warranted and quite likely PE ratio is 20 times on average at that point in time, then Apple's stock price in summer of 2027 would be $160. And that's actually $5 below the current price. So that is not a good investment prospect. Waiting 3 full years for exactly nothing in return. Anybody can agree that's not a good investment. And the downside is that Apple actually stumbles and delivers disappointing earnings and possibly a lower multiple than 20 as well. For example, let's say it only produces a $7 earnings per share and is valued at only 18 times that. That would be $126 rather than today's $165. And you can actually discount the dividends because they are pretty negligible. Over that time of years, it would only amount to about three extra dollars. So that would be a 22% negative return, total return for those 3 years. The upside, on the other hand, is that Apple retains its current premium of 27 times earnings. And let's say that they do produce $8 as expected. That would amount to $216, and plus the 3 in dividends, so $219. So that would be 33% upside in 3 years. Exactly the same as the EPS growth rate, of course. It's a mathematical truism that the stock price rises exactly as much as earnings if the valuation multiple is held steady. But would even that upside case of 33% upside be good enough? Well, it depends on how risky you think it is. So, what does good enough mean, and compared to what? Well, to all the alternatives: not invest at all, to keep cash, a bond, another stock, or the stock index. And for example, since the stock index also is expected to produce about 10% annual returns, except that the stock market is a little bit expensive now, but over time it's expected to produce about 10% annual returns, then Apple is actually more risky than a basket of all the S&P components. So the conclusion for Apple at $165, it's not interesting. It's growing too slowly to compensate for the risk, and its valuation at 27 times, it's way too steep a premium compared to the markets. Actually, we could have seen that right away as a combination of economy-wide style of growth rate and forecast of falling multiple from 27 to 20. So if the valuation multiple falls while the stock the company only performs as the overall economy, then the stock will also fall and be a bad investment. And that concludes this quick run through of Apple for now. What do you want? What is it you want out of life? Do you want freedom, charity, family? Do you want a happy place, admiration, fame and status, revenge? Do you want to travel, eat what you want, when you want? You want to make your dream a reality? So are you ready to be free? Then I invite you to a 6-week training camp that will be as fun as rewarding, and the lessons long lasting, everlasting, lifelong lessons. Everlasting, actually. Value investing will never go out of style, simply because its basis is to periodically get out of style which provides us with opportunity and margin of safety. Yeah, that's right. Since value investing tends to go out of style every now and then that provides us with immense opportunities to sell expensive stocks and buy cheap stocks. In the investing course, you'll meet people like yourself, aspirational, motivated, with ambition. You will learn how to go from just a loose idea about which company to research to making a pretty robust earnings forecast and valuation forecast 4 years out, indicating whether you should rather buy or some other on your growing number of shortlisted companies. So that's a lot. What I'm trying to say is that over the period of the course, you will start accumulating a list of stocks that are interesting, that are pretty cheap, growing pretty fast, that are probably quite interesting. You will learn how to value these, rank them relative to each other, and learn robust methods for making forecasts for their earnings and for their valuations, and thereby for their stock prices and their total returns. So, this is what I have to offer you. If you act right now, I will give you 2 bonuses if you're fast acting. So, you see the countdown? That's the sound of inevitability. So, act now, and I'll give you 2 bonuses. And you will also, of course, have the tremendous value of taking the investing course and taking control of your financial future. So here's a little bit of bragging. Participants in the investing course and the Swedish variant, they say they have never bought a better value for money course in investing or any other topic ever. So grab a seat now. There is a deadline and a maximum number of students in the course. And I understand that you are skeptical. I mean, who pays this much for an online course? Well, who pays this little for this kind of value and for taking control of your own financial future? You don't have to invest that much to make up for the course fee many, many times over in very short order. Well, I'm not a salesperson. I'm not good at sales. I'm not good at selling. I mean, I actually have a documented bad record of selling things. I couldn't even sell my own hedge fund, no matter what track record we had. Luckily, somebody else could do it for me. So it actually was a $1 billion hedge fund. Anyway, I don't even know how to take high enough a price for my investment knowledge after 30 years in finance. This is a cheap course. It's very, very cheap. It's very good value for money. This is the time for you to take control of your money, of your success, of your freedom. The course is completely online. You can do it at your own time. There is no wasted time on travel. There are no oxygen starved rooms. You can work when it suits you. And I am always on call. You can always email me with questions, and you can also use the resource of our online forum for previous participants. So there is no limits to the resources for you to actually learn the material of the course. And the material is actually easy if you just focus a few hours a week for 6 weeks. I promise you that you will become a decent value investor, even a good one or a great one if you keep practicing my methods, which in themselves are pretty simple. But just as with pro golfing or tennis or any kind of sport you want or any skill, you have to practice to become perfect. If I can, you definitely can. I started with nothing. I started with nothing in the wrong end of town, the wrong end of the country, in the wrong country. I mean, I literally started with nothing. Then I moved to Stockholm completely alone when I was just 18. I was totally lost at business school. But over time, I learned to apply a few simple but very powerful tools and rules of thumb, and they together make up the superficially enigmatic stock market. I mean, it's not that hard, really. It's not complicated, but it's complex. It's reflexive. There aren't that many variables. It's like the three-body problem in a way, but less chaotic. and it has more reliable attractors. That is, recurring patterns, recurring combinations of factors that can be classified as a bull or a bear, or other large or small market environments with their own rules for investing, their own local rules for investing. You will know when to be aggressive, when to focus on buying on dips, or when to focus on selling on rips, when to hold defensive stocks, banks, or real estate, when to focus on gold, or Bitcoin, or miners, when to own tech, when to be careful and avoid hot sectors, and so on and so on. These are the things, the rules, your heuristics that I have acquired over 30 years as a finance professional. And now I'm ready to give this back to you, to short circuit your learning curve, to make it much faster, more reliable, and more robust, because you can cut out all the bullshit and just focus on what actually works, what's reliable, what's robust, which is my favorite word in investing, because almost nothing is robust. Here are a few things that you will learn in the investing course. You will know, you will learn how to find a fat pitch. How do you do that? Well, by calculating the stock's intrinsic value and determining that you have a wide margin of safety, as defined by low historic valuation multiple or high target price. You will learn financial modeling. You will learn the practical steps to building a financial model and the three main assumptions to make in your models. You will learn about competitive advantages and when they are durable. A business has a competitive advantage relative to its peers when it generates a higher profit per unit, higher prices, or lower costs, or when it can gain new customers more cheaply or retain them for longer than its competitors. You will learn 14 different competitive advantages a business can have and when they are durable or not, so called moats. You will learn how to build and maintain a watch list for stocks and investments. You will learn how to structure your lists and use them intelligently over the long term to save time and compound your research. Watch many stocks like a hawk, and you will eventually find a buying opportunity. You will learn 40 mental models, principles, and rules of thumb for investing. You will expand your mind by learning the most useful aspects from academic branches like business strategy, psychology, and decision making. You will learn how to read reports like a pro, read annual reports, read them faster, get more value out of them. You will learn how to read quarterly reports, how to use them and other financial reports faster and better in order to build your and maintain your financial models and make more reliable forecasts and more robust valuations and investments. You will learn about business models that you should know, like general ones, value chain, online models, software models, brand based models, real estate, and commodities. You will learn how to learn a new sector fast. We use 4 simple steps to decipher businesses in unfamiliar sectors by understanding which its fundamentals are, so that you can spend your time analyzing specifically those parts and not waste time on the less important ones. And you will also get access to our knowledge and resource database with over 300 resources that we have handpicked. There are tools, websites, sources of financial information that you can use for your investing. We, of course, use them ourselves daily.